And we're back. This is this week's market call for the LongVol Report for the week ending January 15, 2026. I'm your host, Dan Bustamante. We have a lot to get into this week on the market call. I have a lot of updates for listeners of the market call podcast and videocast that we publish. And that first update is this. We're going to be starting, and we've actually already started a new YouTube channel specifically for the market call to separate the other videos that we produce for the LongVol Report. The market call channel will be strictly our bi-weekly podcast and videocast where we talk about value investing, turnaround situations, and updates for those of you that we manage assets for at the investment firm Bustamante & Co. And we're going to be publishing those here on this particular YouTube channel. So you guys will be able to watch all of it here. It'll be easier for you guys, I think, doing it this way and being able to separate for it. So if you're somebody that we manage assets for and you watch these videos because you follow the research that we put out, or again, if you're just learning about value investing or turnarounds or portfolio management, which is what we do, you can watch this channel as well. But I think it'll be easier this year to do it this way because we can separate them and not have people confused on what it is we actually do. Okay, so that's the first update there. The second update before we get into the show, for those of you that are subscribers to our research, we finally have new hats and shirts in. I'll be posting them on the website soon. We've got everybody's sizes. This is one of the back of the shirts. One of the hats there. We've got some other stuff coming in as well for you guys. Coffee cups. They should be at end of the month. I'm excited for those. So you guys can get out there and wear this stuff, show your friends, represent the community, and help us to continue to grow the LongVol Report. And that being said, it's been a great 5 years. It was a great 2025. And we're hoping to continue to grow the community as we get into 2026. And you guys will be able to do that with all your merch and swag that we're sending out to all of you guys. Okay. So those are updates there. Look, I'm excited for this new approach. It'll be easier. I won't have to explain every single time that what we do here is not invest in the S&P and worry about S&P. I'll be able to basically talk more about companies and portfolio management and what we do at our investment firm to give you guys an insight to that, as well as, again, giving you guys insights to going about managing a portfolio in the equities markets. Okay. So that being said, let's kick it off this week. We have a lot to get into in this week's article that I want to get into. For those of you that are new here, you can subscribe at longvolreport.com. When you subscribe, you'll get a free copy of our weekly newsletter. We cover 10 to 15 stock ideas, S&P, crude oil analysis, as well as our portfolio, which I'll talk about on this show this week. So you can get that for free. Just go over to longvolreport.com. Okay. This is this week's podcast, webcast article. It's titled Back to Life, Back to Reality. Yes, that is a song from, I think, the 90s. Look, I was young then, but I still remember it. And that means that Boeing is lifting off, Celsius is rallying. And we've talked about these two companies for the past, at least Boeing since 2024. It's been a company that's been in our research report. We've been a fan of it. I'm going to give you guys updates this week. And Celsius is the second company. If you guys are watching this show and you're outside the United States, we have energy drinks here, as you guys know, probably too many energy drinks. And again, I'm sure they're everywhere. Everybody knows Red Bull. But Celsius is one of those energy drinks. And they bought a company last year called the Lonnie New. It's a big deal for that business. We invested into this business last fall. We talked about it in detail. It started to rally off the lows. I'm going to give all of you guys an update here on this week's market call in that position. Then we're going to get into what we always do on this show. We go through news or noise. We'll go through some market headlines, talk about things that are making headlines in the global financial markets. Is it news or is it noise? What should you pay attention to? What should you discard? And then we'll get to, at the end of the show, the weekly Q&A. If you are a reader of the research report or somebody who watches the market call, go to the website, click on the contact tab. You can send a message in there. We're happy to look at stocks you're looking at, talk about ideas from the research report, but anything related to technical analysis or price action, we're not going to cover on this show going forward. Okay. We'll do it on the other YouTube channel. To be clear, we're going to stick to investing, portfolio management, and analysis of turnarounds and value stuff here on this channel. All right. So that's the introduction to the show. Let's kick it off and get into this week's article. All right, so let's kick this off. Obviously, the year 2026 is going to be, I think, pretty hectic. We gave a webinar 3 or 4 weeks ago, our 2026 Market Outlook webinar. If you missed that, there's a link here. If you go to our website under, again, about free stuff, it should say 2026 market outlook. We gave our views on the outlook for 2026. And some of those views that I talked about were this. Number one, that you're going to see an S&P pullback. Okay. In midterm election years, it's notorious for volatility. If you go back to 1937, I think, again, don't quote me the exact number, it's like 17 to 22% average pullback in a midterm election. All right. Obviously, you're not getting that now, but we expect that. Whether it's 5%, whether it's 10, whether it's 15, that's a big deal. Number two, we expect a rotation to consumer staples, defenses, etc. If you're watching the show this week, and we manage assets for you, that's why some of the stocks in the portfolio we talked to you guys about are going into the portfolio. In fact, this week, I started to build into new positions in consumer staples. Some of them have literally right off the bat. I think one of them's like up 13% already. And we just put it on last week, okay? So that's one of the ideas as well. Number three is small and mid caps. It's the time to shine in the markets here. It's not the time for Mag 7 and AI stocks. We've talked about why. If you miss this, make sure you watch that webinar because we went into a lot of detail. Obviously, Trump has been talking a lot in the past few weeks, okay? He's talked about credit card capping interest rates on that, which wasn't a positive for those stocks. He talked about, defensive names not being able to issue dividends or buybacks. It dropped a lot of those names. He's talked about effectively putting a cap on institutional home buyers, which we like. We'll talk about later. He's tweeting a lot. Okay, what's new? That's what the markets expect. We expect this volatility, but for us and the way that we invest in markets, the way we manage portfolios, it doesn't make a difference. Okay. When you look at the broad markets, when you look at names like Apple or Tesla or anything that are the shiny object or well-known names, they move with the broad market. When the market sells off or when Trump talks about the markets, they typically move with them. The way that we like to invest is we like to buy companies that nobody's paying attention to, that aren't tied to the broad market. Names like a Boeing or a company like Astronics, which we mentioned to a lot of you last August. We bought it in portfolios. It was up extremely well over the past 6 months. And I'll talk about it here in a second. Or names like VF Corporation. Okay. These aren't your growth names. They're not your shiny object stocks. These are stocks that were undergoing turnarounds. Obviously in Boeing, Astronics was somewhat of a turnaround. Now it's a growth story. An obvious VF Corporation. Okay. We like stuff like this, and this is the way we tend to invest in portfolios. This is how our research goes, and for those of you that have followed us for a while or are new here, you'll be able to see how we go about this, okay? Astronics was one of these names. We talked about this in depth literally last August. This was trading at $35 a share. We had a target at 55, okay? The first lesson, and some of you guys know this, so I'm going to give you guys here on the new channel, is this. Whenever we invest into a company, we try to underwrite or value what that business is worth before we get into it, okay? So in the case of Astronics, when we bought this, we thought we could get to $55, $60. We thought that was fair value on this business. Well, we sold our position at 55s. It continued to run. Okay, we mad at this? No. Okay, but the point is we have a repeatable process. When we analyze businesses, we want to understand what's driving that business. In this instance, in Astronics, we've talked about this before. This was a business that was massively affected after COVID. If you look and see what happened here, they provide a lot of aerospace and defense products. By the way, Boeing is 10% of their sales. Okay, so this is an aerospace defense business. After that happened, nobody was flying, that whole issue. It caused the company to do this. Okay, this effectively went into a classic turnaround situation. And these aren't my words. It said it on the earnings report. We talked about it. We posted it for readers of our research. And we ended up buying it at 30 and change. Okay. Now you're at 72. These are things that we like in portfolios. So when I talk to you guys about the broad markets, or we talk to you about, what's going on with geopolitics, Iran, Venezuela, it doesn't make a difference to us. Okay. And this is just one of many examples for those of you that are new here that you'll see on the market call. For those of you that have been here for a while, you'll get to know and understand our approach. Okay. The second name was Boeing. We'll talk about this later. VF Corporation, I'll give you guys a quick update too. Look, these guys have earnings here in about 2 weeks. This is a standard turnaround situation. We've been tracking this company for nearly 2 years. Okay, if you don't know what Vans Corporation is, or VF Corporation, I say Vans, it's kind of what it is. They own the shoe brand name Vans. If you grew up in the States and in grade school, Vans were a big thing for us. Okay, I wasn't a skater, but everybody wanted Vans. During COVID, one of the dumbest things they could have done is they shut down the Vans Warped Tour. The Vans Warped Tour was a big deal for this brand. They shut it down, obviously, because of COVID restrictions. Well, guess what? They just brought it back. And the CEOs that's been in there, the new president, Sun Cho of Vans, is doing an incredible job. I follow them on LinkedIn. We've had to trade in and out of this position. They have earnings in a few weeks, okay? They've done a lot of good things in this company, including paying down the debt, selling off non-core assets. Margins are improving. The cash flow story will turn around, and we expect that the Vans lines improves. This is the story that matters going forward. When they report earnings here in a few weeks, what you want to see from this business, the one thing you want to see is the Vans business improving. If that business improves, this thing is going to be trading back at 30 in an instant. And from there, we think it's got a lot higher to go. Okay. So this is another position we've talked about. Again, this is my opinion. It's not advice. If you guys are just watching this, somebody sent it to you, please, contact your advisor, use our research, but don't go out there and just buy these things, because obviously a lot of them have already moved. This is already up 40% off the lows. This is up way more than we thought it was going to be. And this thing is up off the lows as well. Okay. So that's an update there quickly on that. For those of you guys that get access to our research report, we sent out 3 alerts over the past 3 weeks. Make sure you guys click on those to see what's up with that. Okay. Moving on. The next thing I want to get into on the call this week is the Supreme Court tariff decision. Obviously, last April, this came out of left field. Nobody was expecting this, myself included. And it wasn't fun. Everybody knows what happened. Everybody knows what happened after, obviously. Everybody had a pretty good year. But right now, you're waiting to see what the Supreme Court does. At this point, based on the betting markets, Calll sheet, Poly market, that stuff there's about a 23% chance that it gets approved. My view is this. I don't think they're going to approve it, okay? Now, whether or not they approve it or not, he's probably going to find a workaround to get around it. The key is this, okay? If they rule it illegal, you're going to see a lot of companies trade higher, okay? This is an article at CNBC. With U.S. transportation sector companies, including truckers, have been mired in a freight recession and lower trade volumes. Obviously, there's a massive cause and effect from these tariffs. Okay, obviously, yes, the U.S. government has a lot of money from it. Yes, they talked about sending out these tariff checks. I don't know if they're going to do it. But the big thing is this, and it's not something to be afraid of. This is the truth. It has affected the cost of goods. It has affected small businesses. It's also affected large corporations, Nike, Lululemon, Apple, NVIDIA. We talked about another one the other day, Restoration Hardware. A lot of their furniture comes from overseas. Stanley Black & Decker, which has a lot of ties to China. It's really hindered these companies, okay? So for us and for these companies, it's suppressed the valuation of the businesses. Now, if this thing gets struck down, we expect a short-term rally in a lot of those names. That's a plus for us, okay? So for those of you that are watching this week that have some of those positions in portfolios or own them because of our research, look, if we get that move, we expect a pretty big rally, and we'll probably trim some of that off of that move because I'm sure it's short-lived, okay? So that's an update there on that, and that's the introduction. Let's move on to the next part of the market call, news or noise. This is where we go over market headlines, and we talk about our view and our take. Is it news? Is it noise? How can you use it to invest better in your portfolio? All right, this is a Warren Buffett indicator. Somebody sent this to me last week, and effectively it says the Warren Buffett indicator hits an all-time high of 224%, the most expensive stock market valuation in history. Okay, what does that mean? Is it news or noise? And here's what I said here. I said, I have to be honest with all of you. There are so many indicators to predict market turmoil in the market and the world. And I think more people should spend more time worrying about what could go wrong versus focusing on what could go right. I mean, really, think about it. Everyone is a critic, and a few years ago it was a SOM indicator, and I'm certain as we get closer, there'll be another indicator as well. My point is this, is that the markets every single year climb walls of worries, okay? Do I think that the markets, the broad market, the S&P, tech stocks, NVIDIA, do I think that's overvalued? I do. Do I think, again, this is an opinion, we talked about it in the webinar, earnings growth is slowing the first 2 quarters. Okay, that's not an opinion, that's a fact. We've talked about it if you watch the webinar on large cap names. I do think those larger cap names, the Apples, NVIDIAs, Googles, Amazon, I do think they are going to pull back in the first 2 quarters. I would not want to own those. In fact, we don't own them in portfolios for clients. We've put money into consumer staples. Some turnaround names I've already talked about with some of you that already know. Some healthcare names, okay? That's where we started to allocate to. The small cap and mid cap space will outperform. If you look at Astronics, by the way, it's already started to perform. If you look at this here, you've got a small cap business here. Maybe you can make a case for mid cap, but a small cap business here at 2.57 billion. Again, this was a turnaround story. It's aerospace and defense. Again, you have all this stuff here that are like 3 or 4 green flags to want to own this business. Now, obviously for us, you don't want to own this up here at 72s. You want to own it back at 30s and 35s. You don't want to be buying at these highs, okay? So the best thing that could happen here is a pullback. But you have a lot of things going for you right now. And in the small mid-cap space, that's what we want to be playing. So when I look at stuff like this, does it bother us? No. Is it news or noise? Look, I think it's noise for us. I think for most people that have portfolios with traditional advisors or mutual funds or ETFs, I don't think it's noise. I think it's news. I think you should be concerned that valuations are rich. I think you should be concerned if you're not invested in mid caps, small caps, if you don't have exposure into things, not just the S&P names. That's my general view. Because again, if you watched our webinar, and this isn't just our views, a lot of the bank targets for the S&P are around 7,000, 7,500 this year. Well, guess what? That's where we're trading. Okay. So that's our views on that there. Again, we want to focus on this stuff here I've talked about already. Let's move on to the next news or noise point. This kind of goes towards the defense or the case that the market's not overvalued. This is a chart showing corporate bond spreads tightened to their narrowest in decades. Okay, what this means now, Wall Street speak, for those of you that are listening and watching this week, when you have corporate bonds trading, okay, when the spread starts to widen between the bid and the ask, okay, if it starts to widen up, it means that there's probably a market move coming or the market's worried. This happens all the times in the options market. I'll give you guys a quick example of this, and I'll go through one idea here to show you, literally in like real life, what that looks like. I'm going to pull up a stock here if I can get it to work. And I'll pull up here on the screen so you guys can see this. We're going to a company, Generac, which we own, by the way, and I own options on this company as well as the equity. And this is a great example to show you of what the spread concept kind of means. All right, so let's take this here. Obviously, the market's closed, so the spread's a little bit tight. If you look at the offer on the calls here, this is somebody's willing to pay $850, somebody's willing to pay $960. When these spreads widen up, okay, so if you want to buy it here, you can't get it. They're not going to sell it to you. You have to trade between this, like 925, 930, until the seller is going to fill your order. When these spreads start to widen, let's say the market was open and this goes to like 1060 or 11, what that tells you, or what it tells traders, is that there's a move coming that's going to cause the price to go higher, okay? Obviously, in the bond market, if the spread starts to widen, it's the opposite. They're thinking, the thought process is, there's probably fear or panic in the market, all right? So when you look at this data, and it's at levels not seen since 1988, effectively the way to read that is there's no fear coming, okay? My view is a little bit different. My view comes from this perspective. The perspective is every time you're on lows, there's always fear around the corner, okay? One of the best things you can do, if you're listening to this show, you're new this week, as a portfolio manager. That's what we do. We manage portfolios. We're not traders. We're managing, again, the portfolios with like 8 to 12 stocks. We do some short-term event-driven stuff, etc. in portfolios. Is a good portfolio manager will anticipate risk, okay? When you analyze a company or a business, there's things you're going to miss. And we're going to talk about it later on Celsius on the call this week, where you don't anticipate things, okay? You can do all the work in the world, all the channel checks, all the back work, and something comes out. The other side of the risk management is this, is when the market starts to get frothy and everybody's complacent, you've got to start to worry, okay? So my take on all this, looking at the indicator, the Warren Buffett indicator, and looking at this is this. I don't think there's fear in the market yet. I do think, given a midterm election year, that we are going to get a correction, okay? So I'm ready for it. I'm waiting for it, but I'm not sitting there every day looking for it, okay? We will position portfolios with short positions. We already have some in, by the way, to anticipate it. And when it happens, we'll do our job as portfolio managers and generate P&L when the market sells off as well, okay? That's that. Let's move on to the next thing here. This is news or noise. This is a headline last week from President Trump. President Trump set to ban large institutional investors from buying single-family homes. I will discuss this topic, including further housing and affordability proposals and more, at my speech in Davos in 2 weeks. That's next week, by the way, because he posted this last week. And this is not noise. This is news worth paying attention to. We've been talking about housing for the past 2 years. Obviously, if you look at the housing markets, rents have come down in Austin. I pay attention to that market. Phoenix rents have come down. Things are frozen here. Puerto Rico, where I live half of the year, it's still expensive. It's getting more expensive. But housing market has got to free up, okay? Our take on this is pretty simple. I do think there's going to be something happening here soon. Bassett made some comments last year about it. I don't think this is noise. I think this is worth paying attention to. Now, the next thought process goes to, well, if housing is going to free up, as investors, don't we want to invest in home builders, okay? Our answer to this isn't necessarily no, but it's not necessarily a yes. We're more interested in using these names as something called trading sardines, okay? So instead of investing into them and holding them for this cycle, 1, 2, 3 years, I think you're better off trading them, okay? And I'll explain to you why. The housing builders in the States, yes, they're probably going to appreciate. Yes, they're probably going to move higher. But as rates come down, you have a large demographic of first-time home buyers. By the way, the average age is 40 now, and you can research that. But there's going to be a price war. They're going to have to compete against each other to get the new home buyer. And we don't want to compete with that. What does that do to the business? When you have to compete and offer sales, it drops margins, right? So I don't want to own these businesses. I do think they're going to rally. In fact, if you look at this here, this is the XHB. This is the home builders ETF. Okay, from my technician's view, when I look at this, I'm sure this is going to break out. Okay, I mean, again, this is my opinion. Don't go and put a trade on, by the way. But I'm sure this breaks out. Is it good for 10, 15, 20%? Probably. Does that work for our portfolio? No. Okay. When we buy companies, we buy businesses, at a minimum, we're looking for 30%. So when we underwrite or value a business, if we can't get 30% on our dollars, I'm not interested. Next idea. Okay. Now, obviously, it doesn't always work that way, but we're going into the business or into the analysis process with this in mind. Now, we're looking for doubles like Astronics and some other names. We just put one, by the way, for those of you that have looked at your portfolios, and some that I've talked with in the community about. We just put one in the portfolios last week that's up like 12, literally 12% already. In fact, I think it was up more today. I didn't see the close today, but it was up pretty big. Okay. The point I'm making with this is yeah, housing will rally. It'll be good for trades back and forth. I think the real money to be made, this is my personal opinion, is not through the home builders. I think the money is going to be made on the mortgage companies, on the construction businesses, on the appliance businesses. I think that's where you're going to see a lot of the money made. One of those names is a company called Rocket Mortgage. Okay. If you haven't seen this, this is one of the larger mortgage companies in the US. And again, I don't think it's going to double, to be clear. I'll pull up a chart here and show you what that looks like. But it's been good for trading. Okay. This thing has done extremely well. We'll pull this up here. This is last June into the rate cut rally. It pulled back a little bit. Another pretty strong rally since December of about 30%. Now, this thing here makes a good trading sardine. So for those of you out here that are watching this and can actively trade your portfolios, I like to trade this when it pulls back and rally, because I don't think this is going to go straight up. I don't think this is going to be a double or triple this year. I think it probably continues to do this and is probably pretty close to fairly valued. It's probably got a little bit more to go, but I think it's a good trading vehicle. Okay. So that's our updates on this. I don't think it's noise. I think it's relevant news to pay attention to. Kind of a gift here. We're going to make it fun this year and talk about some other things as well. Okay. Moving on. All right. This is a hot topic as well. Market headlines. Metals are rallying like the rapture is coming. Okay. Maybe it is. Maybe it's not. I'll leave it to you guys to decide. And obviously, this is a big deal for the global markets, is what's going on with gold and silver markets. Okay. Before I even get into this, I'm going to give you my opinion. This is pure noise for us. Okay. We're equity investors. We invest in businesses. We buy good businesses. It's almost like we want to think of like private equity. I'm not concerned personally in our approach to investing on what is going on with gold and silver. Okay. We just don't care. If we were macro investors, if we were trying to read the tea leaves and say, well, what's going on with this? Why are people doing this? Look, I bet there's 50 different answers to why this is happening. I know one of the reasons is because of the COMEX and some things that are going on there. I don't want to get technical in the show this week, but again, it's not a big deal for us. Would I be out here buying this at these highs? No. I think, and again, everybody's writing about it. Forbes, this is a recent article. Would I be shorting this? No. Okay. So from my perspective, I think this is just noise. I think it's noise. I think investors are right to be concerned about it, but what does it mean? Okay. I don't know. There's a lot from this. Again, we don't take that view. I'd rather spend my time finding quality businesses that give us dividends or rate of returns that beat the markets. Okay. We're not here playing defensive game. I'm not here playing Mr. Tinfoil Hat. The market's ending. Let me buy gold and silver. That's not what we do. Okay. There's plenty of people out there with the scare tactics on certain radio shows and AM radio shows that love to do that. In fact, there's one of them in Puerto Rico who loves to sling gold. I'm not going to say his name. He's got a podcast as well, but he's big with the boomers. No offense. And he loves slinging gold. It's not what we do. We buy good businesses. Okay. So that's what we do there. That's our update on that, on news or noise. And yeah, if we missed anything and you guys have questions and you want to cover market headlines, make sure to send them in for the show. Go to the contact tab and we'll put them in for the show in 2 weeks. Okay. Next part of the show. All right. The next part of the show is our newsletter highlights. Again, we publish this newsletter every week. Sometimes we talk about positions that are not in their client portfolios, which we manage money for. Sometimes we do. It just depends. It just so happens this week on Market Call that Boeing is one of those positions we do own. And congratulations to all of you that paid attention and bought this name on the lows, because you've been rewarded by 40% off of the lows since that dip, because nobody pays attention or reads anything until it's too late. And that's how I really feel. And we'll talk about it as we get into it. Okay. We've been talking about this name since 140. We traded it up into here. It sold off. In fact, if you guys have been following for a while, you know what? I told you guys this would sell off. It did sell off. We bought more of this thing on this sell off. Guess what? We still own this. I own Leap options that are up almost 150% at this point. Excuse me. Some other options I have are up a little bit more. I own the equity as well on this. Earnings are coming up in 2 weeks. This is going to be a big deal in 2026 and 2027. Okay. How do we know? Well, we've talked about this a lot with you guys. And for those of you that were at our conference in November, we talked about this exact idea. And it's primarily because of the turnaround of the business. Okay. For those that have talked about this before, free cash flow is turning positive. They're getting new orders. At Alaska Airlines was a recent order. And people will say, okay, well, look, Alaska Airlines got this order. That must mean why the stock is up. It's not. Okay. Context matters in everything in life. And this has been a long time coming. It's just going to start now. Obviously, this news came out last week. One of the largest purchases, by the way, in the Alaska Airlines history. They purchased 105 737s and 5 787s. Okay. Well, this news comes out last week, January 7th. What do you think the day traders do on January 7th? Well, they start buying the stock. Okay. We're going to pull this up here and show you exactly January 7th. This is literally January 7th, right here, from 230 to 250. Okay. Well, we like that. We own this thing from back down here, and we're going to own this all year. So the day traders have now seen this. They're doing what they're doing. They're buying this. Options traders are short-term are buying this, and earnings are going to come out. Well, earnings are going to be positive. The stock, in my view, probably sells off. People that don't pay attention will buy this at the highs, and when it sells off again, we're going to end up buying it. Okay. But why do we like this stock in the first place? I'll explain to you why. We like legacy brands with material changes. That's not just words. This actually means something. When we're looking at investing in businesses, I don't want to invest in some pie in the sky idea that has no cash flow or that may or may not work. There's a growth stock. Look, sometimes they work, sometimes they don't. It's hard for us as investors to value a business like that. Okay. If you look at a growth company like Okla with no revenue, or a lot of these other growth companies, you can ask 50 different analysts and get 50 different answers in the valuation of the business. I don't like that. That doesn't produce consistent returns year over year. And I like compounding returns. If we can produce X amount to X amount a year, we compound that money over and over. This matters to us. This is a legacy brand. It had material changes in the turnaround. We're not predicting, geopolitical issues. We're just paying attention to what is the business doing. Okay. We like free cash flow. This is a big story for this business. Cash flow is about to make a turn for the positive, and it already has last year, and it'll make a big, big turn in 2027. This is free cash flow to the firm. It was negative in 24. Obviously, you guys know why. The story of the business was pretty bad. It went positive last quarter, by the way. It swings positive this year. Then it really starts to swing positive in 2027. Okay. Very novel thought. Who would have thunk that cash flow actually matters when you buy a business? It actually does. We care about like this stuff over and over. So when we buy good businesses, guess what? We want the cash flow. Okay. And that's what we look for. We buy companies. We keep it simple. I'm not going to sit here and pretend we're building atoms at CERN. We're not. We want to build a portfolio of quality performing companies. All right. But those are just words. What about the price action as we head into earnings? And where is the move? Number one is this. I think the move already happened. I think you're going to be late to the party if you buy this, and you're probably going to get burned. So don't go out and buy this and email back and say, Dan, you were wrong. By the way, I'm not your advisor. There's more information on our website to find out about that if you're a high net worth individual. But again, don't go out and buy this on earnings. Okay. I think you're too late to this. You should have been buying it at 190s or 210s. You're probably going to trade into 260s into earnings. I don't think this is just going to shoot right through. It's probably got to pull back, consolidate, and get one last shakeout. Just like it shook everybody out here and here, it's going to shake people out again, and then you're going to have this big rally in 2026, in 2027, and you'll get to what our price targets are. And then when everybody's writing about it and talking about it at CNBC and Bloomberg, and everyone's like, oh, Boeing's actually fixed. We'll be here telling you guys, we know. We've been telling you guys for 2 years they were fixing this business. You got to buy it when nobody else wants it, okay? And then once it's fixed, you get rid of it and you go on to the next, all right? That's my spiel. I know it's a lot. Let's get on to Celsius, the next name, okay? Celsius, okay? If you're still with me, good. Let's get through it this week. I promise these shows are good. You'll be able to learn from them. It is a lot, but like I said, the longer you do this, the easier it becomes. And you'll see within 1 or 2 years, you'll start being able to put up numbers and make money because you have a process and a framework to learn to do this. All right. Celsius and Alani Nu. This is an energy drink business. For those of you guys not familiar with this, look, I'm not necessarily a big fan of these companies or these businesses for one reason. They're typically fads. They're not really sustainable. Okay. 1 week or 1 year, everybody's into energy drinks, and then it's the next. Obviously, Red Bull's been around for a while, but this stuff comes and goes. Okay. This is likely a short-term position for us. This isn't a growth story, excuse me. It might be a little bit if you consider Alani Nu. It's not really a value play. It's kind of a momentum, kind of a cyclical theme. It's also something that'll help us here in this market environment this year. But this company came across my desk last year. The reason I paid attention to is because they bought this brand called Alani Nu. Alani Nu is an energy drink business that is absolutely crushing it with the women demographic. Okay, with Gen Z and millennials. Okay, how much are they making? I'm talking about billions of dollars in revenue. Celsius paid $1.8 billion for this business. They brought it in. This is starting to take over what Celsius is actually doing. Okay, so last earnings report, this wasn't that great. They had some other things I'll cover in a second, but Alani Nu is not failing. This thing is absolutely crushing it, and they continue to do well. This should carry the brand going forward. So why did the stock sell off last earnings? Very, very simple, but the thing is this, nobody reads. I mean this when I say it, I'm not being rude, nobody reads. Earnings came out, okay? The stock sold off pretty nasty. We owned a position. I'll get to the chart in a second. They had a termination of their prior deal with Alani Nu, okay? When they brought this over, they had to terminate the distribution agreement. That was done. The market punished it. It cost them $247 million in costs, okay? That's a lot of money. That's a lot of money, by the way. But what did Pepsi do? Pepsi said, look, this is in their earnings report, by the way. Pepsi funded it, okay? While the company's cash position will not be affected by the termination process, generally accepted accounting principles require the company to record the estimated termination expenses in the income statement, while the payments received from PepsiCo to fund such terminations are required to be recorded on the balance sheet and amortized over the life of the distribution agreement, resulting in a timing difference in the income statement. This is why we sold off, okay? There's also some weakness here, but this is a big reason. Pepsi covered it. That's the reason. People don't look at this stuff. They see it, let the EPS estimate come out, and they don't read the earnings, and they're like, oh, this is why it sold off. It's not, okay? The market punished this stock. It wasn't great for us. We owned it. But again, if you know what you own and why you own it, when situations like this happen, you don't freak out and run and panic. You only add to the position, okay? Contrary to the investing and trading rules out there, never add to a loser, which was quoted by Paul Tudor Jones. He was talking about futures, by the way, which you never add to loser in futures. I know I was a futures trader. You can add to positions like this in a business, okay? Think of it like this. You're buying more of this business at a valuable price, okay? The market was silly. It's always silly. This is why public equities markets are still opportunistic to make money. Markets misprice all the time. This is a classic mispricing. Guess what the company did in these lows as well? You guessed it right. They also did a share buyback. The buyback came in for $300 million for this business, literally after that event, okay? We'll pull this up here on Celsius and talk about it quickly. We still like this. We own this for full disclosure, and we actually added to it on the lows. There's a look at your free cash flow, gross profit margins. There's the debt, by the way. You got to love that. And again, it's a consumer staples. Okay, we want to own consumer staples, and in a midterm election year, they typically do well. And let me pull you up some of the news here in the business. All right. As soon as this thing sold off, okay, literally about 3 weeks later, the board comes out and goes, look, we're going to authorize a $300 million share buyback. You want this, okay? If you're an investor in a business, you don't want the idiot board saying, let's buy back shares at all-time highs and sit there and waste money. They're buying them back. They probably didn't buy all at once. We'll see here what their buyback was. But they announced it on the lows, okay? So they're doing the right thing. The business continues to do well. And here's more information on that transition. This is where it was here. The major ship began December 1st, 25, with a large portion of Alani Nu going direct to consumer. Remember, Pepsi is a big part of the distribution. This matters in this business. And I know this stuff is boring, by the way, if you guys are listening. But again, you know what's not boring? When you guys are up 50 or 60% and you send us emails and you're like, look, I can't believe we just made so much money this quarter. That's not boring, okay? You got to do the work if you want the reward at the end. And yeah, it is a pain, but that's what it is, okay? Costs and funding, nearly $247 million in distributor termination costs, but PepsiCo fully funded these. What a nice big brother at Pepsi to do that for us. And they want to see Celsius and this brand continue to do well, and Alani Nu should do just that. Accounting impact, while cash neutral, the expense was recorded in the income statement, causing noisy financials for Q4 and Q3 2025. Not a big deal. We're not concerned, okay? This came out December 4, 2025. Celsius Holdings says it's achieved 80% transition of Alani Nu integration, okay? This is a big deal. The rest of it will be done at the end of 2026. So it's integrated, it's done, it's out of the way, aka nice. So what is next going forward, okay? With that out of the way, what are we looking forward to earnings season? Alani Nu we have to pay attention to. Earnings are going to come out here in a few weeks, I believe. In fact, let's not guess when we can know. On February 18th, earnings come out. What are we looking for? You're looking to see what Alani Nu is going to do. This thing is already crushing it. Okay, you can read this. And by the way, don't sit here and be like, oh, I'm just going to read it. Read it. Okay, actually read what Alani Nu is doing. Read what the revenues were last earnings report. And if you understand this, you'll understand why we own this business. Okay, this thing year after year is breaking records. Their own records on the product sale. Okay, for whatever reason, I don't care. Do I drink the drink? No. Do I have to drink it to like it? No. Okay, I saw somebody the other day, by the way, on Twitter. He was at Costco. By the way, I went to Costco. I saw the same thing. There was a stack of Celsius, and it was like, oh, it's on sale. And he's like, oh, this must be time to short Celsius. No, it's not. Okay, you got to understand what this business is doing, and Alani Nu is crushing it. And again, Rockstar drop, but who cares? Okay. If this thing keeps up what it's doing as far as sales revenues go, the rest of it's noise, okay? That's our view on this from a technical perspective. Let's pull it up quickly. Look, everybody likes the gap stuff. I'm sure it'll still there at 58s. If earnings do well and they come out blasting, you're probably going to be back at 64s, if not back at 80s into the third quarter this year, okay? We like this name. We bought it on the lows, and I'm glad we did because that's where we are now, okay? That's the final update for the article of the week, right? That's it. Okay, we got through a lot. Now I'm going to get through the Q&A session of the market call. For those of you that are subscribers of the research, I take questions on the show. I'm going to go through a few of them here. One of them was a question on a technical question, which I'm not going to do anymore. I already answered that there. But I did have a question come through. On where is it at? Give me a second. If you guys use that form or if you don't use the form, you send it to me on Discord. Make sure that you highlight it because I talk with some of you guys back and forth, and I have to sift through these questions. There's a question that came through from Shiz from Europe. A few questions. He and I talked, but I'm going to go through a question he had on a stock, and then there was a question. Okay. On the podcast, can you maybe talk a bit about capital rotating from Mag 7 into smaller caps versus rotating out of the U.S. completely? Sorry, I'm not sure I was supposed to post the questions. Okay, yeah. The article is about South Korea versus precisely that. I've been following you rotating out of the U.S. completely should mean chasing different markets. Maybe I missed something. Who knows? Okay. So, and then he talked about reading a Barron's article, which I'll go to here quickly. He read a roundtable article and he read something here. Okay, here are my views on this. Okay, so what he's asking is you're going to see a rotation out of large cap equities probably the first part of the year. Okay, and a rotation into small mid caps, defensives, etc. Does that mean that there should be a rotation into other markets as well? You know, Latin America, South Korea, etc. Okay, there probably is. And the article that you read, and I'm going to give you guys an insight to this, was this article here. And one thing you have to understand is this. And it took me a long time. When I was earlier in this business, 17, 18, I was reading something from Paul Tudor Jones, and he made a comment. I didn't know what he was talking about. Okay, it wasn't until like 10 years later, until I was a futures trader, whatever it was, and I go, oh, that's what he meant. That's not what he was saying, what I thought he meant. When these people are talking here, okay, these people are either larger advisors at institutional firms, or they're managing billions and billions of dollars for 10 years, okay? That's not our approach. And if you're an investor losing less than $5 million, $2 or $3 million, should you have to worry about international markets? I don't think so. Okay. I know this happens all the time. I see it with my friends. I have some friends that sold some businesses recently. Hopefully some of their money comes to us. Some of them are at banks, but they put these portfolios together for people and they include all these, emerging markets because their model says it has to. That's not how we invest. Okay. And I'll give you the first reason as to why. There are plenty of small and mid-cap companies coming to life in the United States in 2026 and 2027. In addition to that, there are plenty of other companies in the healthcare space as well as turnarounds to make money. So what difference does it make for you taking some of your portfolio and allocating it to overseas? If you get rate of return in these companies, you don't have to worry about these discussions, okay? I don't pay attention to this stuff. I know it's widely accepted. I know it's pushed in the mainstream media in mainstream financial management, money management. But again, who cares? These are his picks. And I bet if we go through these picks here, I don't want to say there's not a single one, but I bet there's little to, I can look at some of these right now. There's little to no smaller mid caps. I don't even know what this is. I like this, but he's late to the party on this. We were in this party, NFG, by the way, at 30s 2 years ago. He's late to the party on this, sorry. I like natural gas, by the way, just not these names. Wrong. Don't know this. This is more financial advisor garbage. Financial advisor garbage. And again, nonsense, okay? Again, you have to remember a lot of these advisors put you in this stuff because as long as you guys get 10% or 12% a year and they get their fees, they don't care. It's not what we do. We're after outperformance and we pick companies and we buy businesses. We're not buying random ideas. Okay. I like the Japanese equities markets. In fact, I need to get the forms to a lot of you. I like this. Healthcare should perform next year. So I'd like that idea. The rest of this stuff I just despise. Okay. So the answer to your question is, yeah, you're probably going to get rotation, but don't worry about it. Just focus on small mid caps and you'll be fine. There's plenty of ideas there that you don't have to worry about it. All right. There's another idea that came through quickly. I'll go through it. My favorite stock is Madison Square Garden Entertainment, MSGE, and PGE. As I mentioned earlier, experiences matter. High-end spenders are really spending. We hear that when we talk to management teams from cruise lines to the entertainment world. People are paying extra for good seats and concerts here, willing to go deep. So MSGE, let's take a look at this here and go through this. And by the way, if you guys are watching and you want me to look at portfolios, so I'm happy to give you my take on it. You don't have to agree with it. But when I go through this stuff, keep in mind that we have a framework that things need to meet. So when we look at investments, I'm looking for certain things. I'm not just happy with rate of return. I need a minimum 30%. I need things to fit in the portfolio. So not bad on this. All right, that's decent. Let's see what's up here. I don't know. Look, I know what this is. I don't know the business too well. I agree with your thesis. So the original one you sent on this. The answer would be no here, just based on the chart. Okay, this already ran. If this wasn't, if we were back at 44s, 38s, I'd say yes, but I'd move on to the next idea. I'm not saying you're wrong on this, but this already moved. Let's find something else. Is what I would say. Okay. You sent a lot of ideas. I'll reply to some. I'm just going to go through one more. You pitched one, which we agreed on, which I own in portfolio. I'm not going to talk about that in the show this week. I got to keep that for our clients. Maybe I'll pitch it in 3 or 4. Not pitch it. I'll talk about it in 3 or 4 weeks. We already own it, so I'm going to skip that. Mid-Debbie has focused on the fast food part of the restaurant industry. Once you get a customer like McDonald's or Starbucks, Subway, you grow with them as they expand their footprint around the world. Mid-Debbie's brands include Turbo, Chef, Viking. The stock is selling at a 25% discount to the private market value for less than 15 times next year's earnings of companies, about 7.5 billion market cap. Now, when you say stuff like that, is when I get excited. Okay, so I like stuff like that. Let's look at this here. Mid is the name. Interesting name, by the way. Never heard of this business. What do they do? Literally never heard of this. Doesn't mean it's bad. I just never heard of it. I didn't hear about Astronics, by the way, when I first saw it, so it doesn't make a difference. I'm just giving commentary as I go through this. What do we got? Mid caps, we like that. That's good. Let's have a look-ski. So we got to figure out if there's obviously something with the business not growing. I'll look at some other things here in a second. Is this going to inflect and get out of this? Because it hasn't been growing. Or this was growing. There's something here. Does that change? We have to figure that out. I don't know. This is a big deal. Okay, so instantly, I know you're watching this, so take this, figure out what they're going to do with the money. Figure out what they're going to do with this money. That's a positive check tailwind here. So that's a good sign. I like this. Let's see what they're going to do. This is also a positive, 15 billion bucks. All right, you got something here. Okay, let's look at that one. Okay, and yeah, let's look at this one. All right, I like that. Good eye, good catch. So you and I will go over that. I'll talk to you in DMs about that. Okay. Look, there's a few more I'm going to go through. I'm going to save it because the shows, I don't want it to be longer this year. I want it to be 45 to 60 minutes tops. We're at 50 minutes already, and that's going to do it. Okay. So that's the market call for the week ending June 15, 2026. If I said 2025 earlier, forgive me. We'll get into the groove of things here going forward. Do not forget, going forward, it will be on the channel. It's youtube.com. The market call. So the actual @ the market call. All the webinars and market calls will be posted there. The other videos that we produce that are shorter will be on the regular website. Okay. That's going to do it for me. Thanks for watching. I'm looking forward to doing more of these in this format 2026 with all of you guys. Please send in your questions. We'll go through them and we'll all be able to make some money and grow this community in 2026. Thanks for watching. I'll see you guys in 2 weeks.
Thanks for listening to this episode of the LongVol Report with your host, Dan Bustamante. Make sure to like and subscribe on your favorite podcast platform so that you never miss an episode.